Good evening and welcome to the Silicon Valley Entrepreneur, a series of conversations with startup founders and the investors who fund them. I'm Chris Gill, President and CEO of SVASE, the Silicon Valley Association of Startup Entrepreneurs, the largest and fastest growing non-profit for entrepreneurs in Silicon Valley. Tonight I'm pleased to have with us Jeff Clavier, founder and managing partner of SoftTech VC. Jeff, pleasure to have you here. Thank you very much for coming along.
Thanks for having me again, Chris.
Can you tell us a little bit about SoftTech VC?
Sure. So SoftTech VC is a firm which I founded about 6 years ago. The goal of the firm was to figure out essentially a new model to invest in early stage startups in the consumer space. In 2003, 2004, when I was still a more traditional VC, I saw an opportunity to invest in this new generation of super capital efficient companies, and so decided to leave my job as a general partner, found the firm, and for 3 years I did 24 essentially angel investments, so using my own money. Figured out a few things, had a few exits and a few successes, and in 2007 raised my first institutional fund. We call it SoftTech VC2 since the first fund was my own money. And that was a $15 million fund that has invested in 58 companies since then, becoming one of the most active investors in the space.
So 24 companies and 58 companies on top of that.
Mm-hmm.
Wow, that's a lot of companies in a very short space of time.
That's, in 6 years. Essentially, the whole idea is you can take an angel strategy and scale it at the institutional level, always syndicate with other high-value investors, whether seed funds or individual angels or sometimes traditional firms, to build a very strong support foundation for the companies we decide to back, and for 12 to 18 months, be there, support them, help them, mentor them, getting through product definition, product launch, initial, successes in terms of revenue model, maybe, and so on and so forth, so that they get to the point where they interest some VCs and they'll get their $3 to $5 million Series A done, and then they can go and execute for a few years and hopefully build a really interesting company.
Okay, I'd like to dig into that model some more so we can explain it to some of the people watching, but you're now classified as a super angel. You're one of a relatively small elite group in Silicon Valley. What differentiates a super angel from the average angel?
So first and foremost, super angels, we've been called super angels for about a couple of years now, and it's really a misnomer because the people who are referred to as super angels are essentially micro VCs, so people who have been angels themselves, have been successful, and have raised institutional money to essentially scale their model. Mm-hmm. And so we're really micro VCs or mini VCs or whatever you call us, but we're VCs. And for some reason, some people in the press, I guess, have decided that micro VC is not really sexy, whereas super angel, big flapping wings, is something which is kind of interesting. And so that's what we call super angels. Essentially, that's a group of 10, 12 firms in the Valley, and I would say 2, 3 firms on the East Coast that essentially have raised institutional capital anywhere from $10 to $50 million, and are investing those dollars into a very large number of portfolio companies. There's no set number. Some people have a concentrated strategy. They might do 5 to 10 deals a year. Some others have a less concentrated strategy, and they might do 50 deals a year. But the idea is to really sort of always come up with a syndicate that will essentially fill up the different roles and try and help with the different issues that early stage startup might face in their initial development by putting this sort of Ocean's 11 team together, so that you have the better probability of breaking the bank, or in this case being successful.
Okay, so in your case, it's 100 companies over 6 years. So
it's a bit less than that, but yeah.
Something
getting
like
getting there.
So 15 to 17 companies every year. And that's a lot more than the average VC does, who's doing, each partner in a VC firm might do 2,
Yeah,
3 a year.
2, 3 a year, and 2, 3 a year would be busy for them. Yeah.
So you're doing 15 to 18, something of that order. What is the strategy behind that? Because that's a lot, and given that there's so many of them, What help can you really give them? Because if you're sat on the boards of these companies, then how do you manage to make all the parts work?
So a bunch of great questions in this. So I'm going to try and answer all of them as I go. First and foremost, I don't sit on that many boards. So I have done historically, let's call it 80-ish investments, and at any point in time, I'm only sitting on 6 boards. And so if I lead an investment, I put together the syndicate and I define the terms, negotiating with the entrepreneur. I'm going to sit on their board for maybe 18 months, which is typically the time for which the seed investment is sort of the primary investment. And as a more traditional VC firm joins and leads the Series A and joins the board, I will, after a little while, sort of step back and still get involved in the company, but not at board level. I think that the secret of the work we do is our ability to really help a large number of touch and help a large number of companies on the basis of phone calls, emails, traded with very specific objective and very specific delivery. And so my role is to try and figure out how to respond to any request from one of my CEOs as quickly as possible. And sometimes it's making an introduction, sometimes it's doing something myself, sometimes it's saying, hey, you are developing a pattern, let's say, in terms of customer acquisition, which is similar to 2 other of my companies. Let's go and talk to them. And there is an implicit, support. I wouldn't say contract, but people understand that they need to help each other. And so CEOs who have figured something out will help other CEOs in the portfolio. And so this network effect that we get once we have a large portfolio actually does happen and does work. I think it's true that people often compare the number of companies that a traditional VC will have versus us, and we just have a different type of engagement, different type of support, and we are actually very complementary. There's been some kind of a rift being developed in the press, or it's as though there was a rift between us and the VCs, and it's not. We need them and they need us. We bring them deal flow, and they figure out which ones they like and which ones they want to work with, and then off they go. Out of the 80 plus companies I've invested in, 40 have raised close to $400 million in follow-on financing in aggregate. Without the VCs, actually can't get them funded, right? Because when people talk about capital efficiency, it's not that you can build a tremendous company on 500K. You can prove a lot of the thesis of a great company on 500K, and then you might go off and raise 5 or 10 or 50 or 500 million, like Zynga or Facebook. And so it's not so much that we've shrunk the needs for financing of the companies, we've shrunk the actual cost of failure. How much does it cost to figure out that this was actually a bad idea in the first place? Right.
Okay. Why is it that this has happened relatively recently? What has changed? What has made this something that's been of value now rather than in the past?
Well, I think it's so. First and foremost, let's be clear. This happens in the consumer internet space. This happens in the software space. So enterprise, some portions of enterprise software, but it doesn't in clean tech, new energies, or anything requiring fabs or components. What has happened essentially is if you look at the cost of computing, if you look at the cost of software, if you look at the cost of resources, they've all dropped to pretty much nothing or zero. Nothing being sort of just an incarnation of zero, like an hour of computing on EC2 or S3. And so there has been a number of enablers in the market, web services, open source software, very cheap, computing resources that have just dropped the cost of operation for those startups to not much. If you look at how they market themselves, people have invented virality, which is basically free customer acquisition or almost free customer acquisition, even though now it's no longer the case. And so where you used to have, $1 million spent on hardware, $1 million spent on software, $1 million spent on red herring ads, and a couple of $1 million spent on resources and engineers and everything, here you go. You have your $5 million.
Yep.
And we've basically slashed those costs by 10 or 20.
Okay, but that doesn't apply to the other areas you talked about, so life sciences, clean tech, semiconductor, those areas still have to go the conventional venture capital route. It's only in the consumer internet and computing areas.
That's my perception, because I actually don't touch any of those areas. I think that you invest in what you sort of understand, where you sort of know what you're doing.
Right.
But I wouldn't comment on anything related to life science or clean tech. I just hope there was sort of capital efficient ways to build, to discover new drugs or manufacture new drugs, because that's what the world needs. And likewise on the clean tech and the energy side, but those require typically quite a bit of an initial investment,
okay,
to figure out whether they're viable or not. And if you look at the FDA approval process, which is extremely long and complex and costly, I heard at another event today that people in the medical life science sort of space were actually going to Europe now to try out new devices, just because the cost of the rubber stamping is actually much, much lower in Europe now.
Okay. So one area that I've got so many questions going around here in my mind. It's difficult to do them all at once, but there's the model that you have for investing in lots of companies. There's been some press that has indicated that our super angels looking to just build a generation of companies that would be small companies,
deep shit companies, as they were called.
Yeah, sold in the $15 to $50 million range, or are you looking to build the big companies, maybe the thunder lizards that some people talk about? What do you think is happening in the venture world today?
So it's a great question, and we could spend 3 hours on that, because it really depends on the aspirations of each and every entrepreneur. And I think that fundamentally, I might have my own view and objectives and hopes for a company, and certainly I will not invest in a company where I don't see a certain scale. And scale, there is sort of it's a cliche, I know, but looking at the business fundamental of a company and figuring out whether you can see a scenario where the company goes through 5, 10, 20, 50, $100 million in revenue, right? Where most likely at some point it will figure out how to make money if they make that level of revenue. It's sort of a test I try to apply. And sometimes, I really like the company and I'm not sure I see exactly how it's going to monetize, but I think, there's a good shot at figuring it out later, and I go for it. And sometimes I will just say, look, I don't see how the business can scale. And so my own objective is to help entrepreneurs really build sustainable long-term growth companies. However, sometimes it happens that those companies are interesting to larger players, and they try and pick them up. And I've had 16 exits in the past 3.5 years, 4 years, and I would say that half of those times, those acquisitions were way too early. I've had one of my companies being acquired after 6 months, and many were acquired after 3 years, and you just don't have the time to build a long-term sustainable company by in those 3 years. However, if that outcome is a life-changing event for the entrepreneur, and it just brings them a set of not only sort of wealth, but just comfort, personal comfort for the family or whatever, I will never, ever say no. I might have a private conversation, which might be sort of heated with a lot of expletives, saying, this is insane. We could
Right.
go further and so on and so forth, but they will all be private. And then, in terms of public statement, I will always support my entrepreneurs. And, I was extremely lucky to be involved in Mint. And so we had this $170 million exit to Intuit that has been pointed to as a failure. I mean, since when $170 million of value created in 3 years is a failure? Okay. There were, Tapulous I was also involved in as one of the early angels. And, we exited after 2 years to Disney. Whilst this was one of, the third largest application on the App Store with 35 million downloads and 1 billion game plays. And certainly that one had a lot of potential, but hey, the team decided that it was actually the right thing to do for them to join Disney and actually use that massive platform to go to the next level. I won't say no.
Right, and certainly this is something that as a not hugely active angel, I see on the angel side where we're much happier investing 1 or 2 rounds and getting an exit in the $15 to $50 million range. It is, as you said, it's a life-changing amount of money for the entrepreneur because they've still got 50% or more of the company, and so they can walk away with $5 to maybe $20 million. Somewhere on the right. Whereas if they're going the conventional VC route, the average amount that that a founder might have on exit is 5 to 7% of the company. Maybe a little bit more, but not much more.
That could range depending on the number of founders. Could be like 5, 7, 10, 15%.
So there you're talking hundreds of millions of dollars to get the same amount of money for the entrepreneur. So, and the time and stress to build that relatively modest company versus the big company and the same payback, you can see why entrepreneurs find it attractive.
Yeah, but I think, and that's where I'm really not comfortable with the message of, hey, let's go build $15 million exits, because those are tremendously difficult to have, and so you can't plan for a $50 million exit because you fail most often. Like if you calibrate, if you make, because you're not going to build a $50 or $25 million exit or a $100 million revenue company the same way. Vinod Khosla has this sort of tremendous image, which is when you start, you build the foundation of a $0 billion company. So you make the choices in terms of the initial sort of hires and the kind of company you build in terms of culture right there and then. And the $0 billion company is basically something which has the potential to scale. And I think it's an image which has tremendously impacted me when Vinod sort of shared it. And so I think that there are entrepreneurs who just want to build something big and will just not stop at $50 or $100 million, and they will just try to go the whole way. And I respect both, and I'm not going to say I want to only work with those and not the others, because at the end of the day, you can't plan how you're going to react to an opportunity which is going to impact you personally and your family 3 years, 4 years, 5 years down the road, right? And I've been there, I've been doing this for 6 years, I've been investing for 10 years. And so people would have, told you I'm going to build a $2 billion or $3 billion or $10 billion company and I'm going to just take over the market, might just, take a personal outcome in the tens or $20 million, 3, 4 years later. And I won't say that they're softened, I won't say that they're bad. It was just, a personal circumstance that led them to that decision. And I think it's always sort of very easy to sit outside and tell the entrepreneur what he should do, what he should think, and so on and so forth. You're not in his shoes.
No. Now you're quite accessible, unlike lots of other angels.
Trying to.
And what are your basic metrics for deciding whether a company is interesting to you or not? Do they have to have traction? Do they have to have a killer team? What do they have to have that makes you say, "Yep, I'm done. Let's invest"?
So, it's another great question. Typically, the way I try and explain the thinking is, think about this sort of giant scale on which you're going to put different types of weights, small weights for, little things, and large weights for how good the team is and how long they've been working together. And Are they sort of experts in the field and therefore they're going to cook something really special? Or are they completely new to a given field and therefore they have this radical idea that no one has thought about because they come from outside of the industry? And you sort of put all those weights on the scale, and then at some point it might tip and you're going to invest. And so for me, the fundamentals are the team, the product, and the market. The team is the most fundamental because by definition you're betting on the people, on their ability to work super hard for a bunch of years to come up with a unique differentiated product or service that will have scale and that will come up with ways to work with the issues they're going to face, because it never works ever. There's always issues and problems and lawsuits and backfires from users and so on and so forth. Even the most successful companies have them. And so the resilience, the sort of passion on the founders is something that you want to figure out right at the beginning. The product has to be sort of differentiated. You can't, and I could say you don't want to invest in yet another knockoff of Groupon, but they seem to all work. So what's wrong with those, right? And market has just to the test for the market is can it sustain a company that can get to hundreds of millions of dollars in revenue? Meaning, is it a niche? And if it's a niche, it has to be a really big niche, right? And if those tests are sort of satisfied, and I can feel I get along with the founders because we're gonna hang out for a long time. Yes, sometimes you exit after 6 months or 2 years or 3 years, but the average time to exit is 5, 7 to 10 years. And so better have a good relationship because we're going to hang out a lot. And so if I can feel this sort of personal attraction to the project and I can see myself involved, I'll write a check.
Okay. Now you mentioned there's often knockoffs of one leading firm. So Mint, as you mentioned, that was an interesting one where actually they were not the first entrant into the field. There were multiple other people who've tried to do something similar over the years, but they were the ones that made it happen, which was interesting. Do you invest in more than one company addressing a particular area, or will you only go with one? Once you've invested in it and that's it?
So typically I'm going to be paranoid about avoiding any overlap or conflict of interest or competition goes. As actually a very active investor where I tend to be really involved on the product side, on the marketing side, if I can't do my job because of a potential conflict, then I've really screwed up bad in terms of my investment decisions. Sometimes companies pivot. I've had the case where two companies were doing two completely different things and ended up competing, one against the other. It actually the resolution was that one got sold to or got acquired by AOL last week, so ThingLabs, which was competing against Sysmic in the desktop client space and web client space for Twitter and social networks. And I'd never planned for this to happen because the two of them were doing something different and they both pivoted. So I try and avoid this as much as possible. And so my thinking is, whenever I invest, I basically put some kind of a ring fence them with a lot of white space so that they can sort of move around and avoid any overlap. Okay.
Changing tack a little bit, bigger question because we're starting to run out of time. At a recent Money Tree event that we held, PricewaterhouseCoopers presented some numbers. It was something like $20 billion has been invested in companies recently.
And 12 billion was raised.
12 billion was raised and only 10 million on exits, 10 billion exits. What's your view of all of that?
Well, it's clearly not sustainable. And so there is billions of dollars in the coffins of VCs. The Money Tree survey sort of showed that the 10-year return of the VC industry is negative, meaning that for 10 years, VCs have actually not returned the cash that was given to them. So it's clearly not sustainable. And at some point, limited partners, the people who invest in VCs are going to say, enough. And I would say a couple of years ago, they started triaging, the managers and their relationships by cutting off the ones that were just not performing. And so we're going to see just, a decrease in the amount of capital invested just because VCs can't invest more than what they raised. It's sort of mathematical. And so I think it's, most of the GPs, the general partners who have been in this business for 10 years, 12 years, 20 years tell me that this is the worst possible environment they've ever faced in terms of fundraising, just because the LPs have just turned the screws on and they just want to see performance.
Okay. And yet, there have been a number of micro or mini funds started in recent months that seem to be getting, as you say, 10, 20, 30, $40 million, almost without even trying, apparently. And there seem to be plenty of people who would love to be in the shoes. I'm sure it's not as simple as that.
Yeah, I think.
Can you talk a little bit to that?
I think that the environment, unless you are, personally wealthy and therefore you just fund your own 10, 15, $20 million fund, I think that the people who've actually raised, recently, my friends, Eden Sankat, Mike Maples have been tremendously successful, in their past endeavors as angels, and therefore, they have track records and performance that are way above what, the VC industry has been providing. And so I think what limited partners are bidding on is that those smaller, nimbler organizations are able to provide, alpha, meaning, yes, they could return 2 or 3 or 4 times their fund, which is sort of the minimum expectation. But who knows if they get the next Google or Yahoo or Facebook in their fund, then they will have a tremendous uplift in performance, and that's what those guys are betting on. Okay,
we're pretty much out of time now. It's gone by very quickly. Any last words of wisdom for the entrepreneurs watching the show?
I think it's a tremendous time to start a company. I was telling you in the pre-show that I've just been shocked by the amount of interesting companies I've been seeing ever since Q3, Q4, 09, and it doesn't stop. And there's more coming. The mobile space is interesting. The web services space is just going all over the place. Starting to look at a few things back in the enterprise. It's just a good time.
Terrific. Jeff, thank you very much indeed for your time. I wish we had more time to talk.
Thanks for having me.
And it's thanks and good night from the Silicon Valley Entrepreneur, and see you again next month.